terms of the other key features of the global backdrop, in March, after a lot of toing and froing, the European Central Bank launched its quantitative easing program. It started in March. There's going to be a bond purchasing program of €60 billion per month out to September 2016, and that's a total stimulus, monetary stimulus of 1.1 trillion that will be pumped into the Eurozone banking system. And the hope obviously is that that money will find itself into the real economy and will reignite economic recovery. The market view certainly has been that in the second half of 2015, upward pressure would, or at least pressure would start to emerge on the Federal Reserve Bank and the Bank of England to start tightening interest rate policy. I think it's unlikely that that's going to happen this year. I think that's more a story for 2016. But I suppose from a market perspective, the risk certainly would be in the second half of the year that we'll see continued pressure building on both those central banks to increase interest rates. As I say, I think it's a story for 2016. And even when it does start to happen, I would regard it as a path to normality rather than a tightening of interest rate policy, because let's face it, for the last few years we've been living with zero interest rates in the United States, 0.5% rates in the UK, which is a highly unusual situation. And once growth starts to pick up in a more meaningful way, both central banks will try, and they would like to bring interest rates back to what they would regard as more normal levels. But when it starts, as I say, I think it's going to be 2016 rather than 2015. It's going to be a modest upward trend for rates. In terms of the interest rate environment that most affects us, the European Central Bank, there is no pressure whatsoever on the European Central Bank at the moment to move away from its 0.05% official interest rate policy. Another feature of the global backdrop is obviously the Greek situation. It is now starting to reach a head. At the end of this week on Friday, the Greek government is expected to repay, I think it's 300 million euro in debt, and during the month of June, 1.5 billion has to be repaid. The fact is the Greeks don't have that money at this juncture, because the debt repayments we saw in May and the debt servicing was really driven by the Greeks raiding all sorts of emergency funds, both at an IMF level, and also they've been taking money from local authorities and so on in Greece to try and keep the economy ticking over. So with 1.5 billion in debt repayments due this month, and with the money not there to meet that debt repayment, clearly one of two things is going to happen. Greece will either default on its debt, which will be the beginning of the Greek exit from the system, or secondly, some sort of compromise will be reached with creditors and Greece will survive in the euro. I think the latter is more likely than the former. Euro weakness is another key theme at the moment. We've seen over the last 12-18 months, particularly in anticipation of the quantitative easing program in the euro area, the euro has lost considerable ground against sterling and against the dollar. And I suppose my final point globally would be that the key objective for policymakers is to try and boost inflationary expectations, because if you are caught in an environment where prices are stagnant or falling, it has a serious impact on business confidence particularly. What you need to see happening in the system, some inflation is good because it tends to feed into confidence and tends to become a virtuous cycle. So policymakers will have to remain, and I believe will remain, totally focused on trying to increase inflationary expectations across the global economy. And it's interesting, in the euro area, as I said, yesterday we got the main numbers showing an inflation rate of 0.3%. The European Central Bank will have greeted that pickup in inflation with open arms, because what they want to see happening over the next 12 months is the inflation rate to move back towards its 2% target.